Are you looking to buy property in Florida without having to deal with those pesky banks, or maybe you don't have perfect credit? Then this video is for you, because we're going to be exploring some of the creative financing options out there for you here in the state of Florida. Now here's the deal. I have been a licensed real estate broker for almost 20 years here in Florida, and I've seen a lot of different creative ways to be able to make a transaction happen. Now, whether you need to have some type of creative financing because you do not qualify for existing conventional financing, or if you just don't like dealing with the banks and the loads and loads of paperwork and tax returns that are required, then there's some good options for you that are out there. So let's jump right into it. First on the list would be something that I would explore first, right? This is a great option because in this market that we have today, there are a lot more motivated sellers than there were in the past. They're willing to negotiate on price and potentially other terms, and what I'm referring to is seller financing. So in a scenario where the seller is able to hold back a certain portion to them in a note, in a mortgage for you, that's a really good scenario because you've got a seller who's motivated to get the deal done. You're wanting to get the deal done as well. And if it's just the mortgage that's in the way, maybe the seller is able to help out with that. Now, here's the potential challenge in a situation. What happens is when the property sells, the seller is typically required to pay off any existing loans that do exist on that particular property. That means that if they have to pay off, let's say that it's $1 million sales price as an example, they have a $600,000 loan, they would have to pay off the $600,000 at closing, so they really only have, for the sake of round numbers and not talking about closing costs, $400,000 of equity in that particular deal. So if you needed to get a, private loan from them, they would only have $400,000 in that example to be able to loan based on the sale, and you'd have to bring the $600,000 in cash. This typically works better in a scenario where the seller has a lot of equity in the property. So they either have no loan or they have a very low loan on the property, so that we can work out a scenario where you put down, maybe 20% down into the property and they hold the note for the remainder. This can be very handy if maybe you started a new business a year ago and you need 2 years of tax returns in order to qualify for conventional financing. This can potentially get you down the road, and typically seller financing would have some type of a balloon payment that would be due in a period, and whether that's 1 year, 2 year, 5 years, something like that down the road. The seller's not typically going to finance you out for a period of 30 years. You don't see that happening. The other benefit here is that a lot of times you can negotiate on what that interest rate is. So if they're looking at, hey, what is that money going to make me if I put that into my bank account? What is that money going to make me if I put that into a CD? Or what is that money going to make me if I put that into some other investment? If it makes sense for them to do it, a lot of times it's a good return for them to be able to get some cash flow if they did not need all of that cash anyway. So that's a great option for option number one. Option number two is something that is called subject to financing. And so what this is slightly different in that what happens here is that the buyer gets under contract to purchase a property, but they take over the existing seller's mortgage. They start paying it. This is different than an assumable mortgage, right? They're not assuming the mortgage, but they just start paying it after closing. Now, there's a lot more challenges with this subject to than there are solutions, in my opinion. We don't see this one happen very often because most mortgages have something that is called a due on sale clause, which means that once the property sells, that the existing mortgage is required to be paid off. It is due on the sale. And the only way to get around that is if it's not due on the sale and the title company or whoever is performing the closing does not require that that is paid off. So the majority of the time it is required that that loan is paid off, so it doesn't work to do subject to, but it's an option out there, so I at least wanted to make sure that we covered that. One other creative option would be something that is called a lease option. And so with this lease option, this is a way that you are able to lease a property, not necessarily buy it, but you are guaranteeing that you're going to have an option to buy at some future date. This option usually costs some money, and that money is negotiable. So maybe that's $10,000, maybe that's $25,000. Maybe you are able to negotiate that less, but then you are guaranteeing, you're locking in the option to buy that property at some date in the future at a predetermined price. This works out really well if the price of real estate goes up, because you're locking in a price with the seller, you're giving him that option, you're giving the seller that option money, and then it's guaranteeing that in the future they will sell it to you at that particular price. It does not work so well if it was a declining market, right? You lock in the price today, the market declines in value, all of a sudden the property's worth more, and you said, hey, I have the option to buy it at this higher price point. You might be better off walking away from the option money, and you're just out that money. So if that's $10,000, you'd be out that $10,000. But this is a way to pre-negotiate terms, be able to lease a property for a period of time and not have to come up with a down payment right then, but you are already living in the property that you plan to live in for a very long time. It can work out really well, and this is something that we have actually done in the business. Next on our list is probably the most popular creative financing option that's out there, and this is through private lenders. So private lenders are not necessarily banks, right? They may have much less requirements than a bank would, but in return you might be paying a little bit more in interest. So we have seen this happen many times, especially when it comes to investment properties, because there are a lot more rules and regulations around if it's your primary residence. But if it's an investment property or commercial real estate, etc., there are much less restrictions that come into play as far as what a private lender is able to do with a lot of the lending requirements that are out there. So what we see a lot of times is that private lenders do require a pretty substantial down payment. Most are wanting between 20 and 30% down. Why do they do that? Because they're not making you jump through the same hoops that a conventional lender would by going through all of the paperwork, all the documentation, running the credit, all that stuff. And so they're saying, hey, we're going to take this pretty big down payment and we're going to give you this money. But typically these do have some type of a balloon payment that's due in a 5-year period, and that again is negotiable. Now, interest rates typically are higher on the private lender side, and that could be anywhere from, say, 3 or 4 points above what a conventional finance would be, up to, I've seen things be 10% higher than what you could get on conventional, conventional loan. So it's, for certain scenarios, it makes a whole lot of sense to do this, especially if you're using it as an investment. Maybe you're looking at a flip and conventional financing doesn't work and you only need money for short term. And so there's a lot of people who don't want to jump through all those hoops to be able to make it happen. And it helps them get across the finish line a lot quicker, a lot easier. And it's just, they're able to secure that money. Now, not all private lenders are created the same. There are some that have better rates. There are some that charge incredibly high closing costs. And so you're going to want to make sure that you're working with a true real estate professional who has a good network of private lenders so that you can understand what options are out there for you, because again, they are not all created equal. Now, me and my team would be happy to discuss any type of real estate transaction with you. If you need creative financing, conventional financing, or hey, you're just a cash purchaser who's looking to make something happen in the state of Florida, that's where we're licensed, we would be happy to speak with you. Now, all of this should go with a grain of salt to say, hey, we should have an attorney. Make sure we're following the proper laws, etc. when it comes to financing. There are a lot of different rules and restrictions, and so if you are interested in this, it's just a good idea to have an attorney as part of this equation. We're not attorneys, we're licensed real estate agents and brokers, and so I just want to throw that out there to make sure that you are always protected. As always, it is my honor to be able to make these videos for you. If you could like the video, subscribe to the channel, that really helps the YouTube algorithm to get this video out to more people out there, and leave a comment below. I'd love to hear from you. Have an amazing day. Thanks.